So there is a ton of just insane stuff currently happening to Senseonics stock again, actually being up almost 10% since the recent pullbacks from the incredible 150% jumps in price we've seen after the crazy 1,580% gaps in January. As we are down almost 3% on the week, however, what we are going to do today is give you an updated insight into what is happening to Senseonics stock and break down exactly whether it is still a buy at the end. And as the analysis in the video is absolutely crucial to consider before buying the stock, make sure to stay tuned. But before we jump right in, just hit that subscribe button down below. And as we'll keep you updated on breaking news and awesome trading opportunities every single day, subscribing would not only help us but also you. So there is really no excuse for not smashing the subscribe button. It's free, and you can always unsubscribe if you feel so. Alright, so let's start talking about the stock. And in the case of Senseonics, we're looking at one of the major producers of glucose monitoring systems, or CGMs, which make the process of testing glucose much easier for people with diabetes. But despite the company's relatively high-growth business plan, which we'll look at in a moment, the real reason for the recent tremendous gains was a completely different thing: some huge hype, especially from retail traders. In fact, this incredible excitement caused the stock to soar more than 1,500% at the start of the year, in addition to the recent 150% recoveries we've seen following the pullbacks. And there are a few major aspects that allowed these incredible jumps in the first place, starting of course with the single-digit price and a small float of just 280 million shares at the time of the first breakouts. The single most important thing, however, was the short interest at more than 25%, making Senseonics stock a perfect short squeeze candidate, similar to most other meme stocks that gapped up massively at the time as well. But with Senseonics, it's also the business model of the company that makes it so much more interesting, especially to investors. And, in addition to the remarkable progress Senseonics has achieved in commercializing its product line in the multi-billion-dollar diabetes market, which also is one of the main things investors are currently betting on, there is one thing in particular that sets the company apart from its competitors: the Senseonics Eversense XL device. However, as said before, and as we will see in our prediction at the end of this video, these devices have not only attracted the interest of investors. In fact, Essentia, a prominent player in the worldwide diabetic care market, has recently partnered with Senseonics. And as part of their deal, they agreed to distribute the Eversense XL product across Europe, opening up a large new market with enormous potential and opportunity. Furthermore, Essentia has extensive experience in the industry, which will be especially beneficial in establishing the brand in Europe, while Senseonics, on the other hand, has a number of significant advantages over its competitors in the United States. The Eversense XL, for example, is the world's first long-term implantable glucose monitoring system, lasting more than 3 months, a significant improvement over the standard 14-day duration. So Senseonics basically has two main reasons to skyrocket. The first is the high short interest, and the second the revolutionary product they've built. But this isn't the only thing about the company that seems pretty appealing. Taking a look at the recent earnings reports, it appears to be trending in the right direction. It brought in about $3 million in income, representing a staggering increase of over 7,000% year over year. And with cash on hand of nearly $200 million and debt of only $110 million, the company's revenue expectations of $15 million in the next earnings release, which will go public in literally just 4 days, seem reasonable. So taking everything into account, Senseonics has a bright future, particularly in the rapidly rising diabetes market. And although you have to consider that there are still some execution risks with the stock, while investors have to see a continuation of the current growth to justify the recent jumps in price, they've also brought a lot of volatility with them. The stock has certainly been moving in the right direction. Additionally, we got a really solid product line, being able to lead the global diabetic care market with some unique features which give it the edge over its competition. Alright, with that being it for today's video, thank you very much for watching. If you liked this video and want to support our mission of providing free financial information to everyone here on YouTube, please ensure you're subscribed and definitely consider leaving a like. As mentioned before, it really means the world to us. Thanks a lot, and see you next time.